Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And this week, a cold truth you need to hear. Nation, the AI revolution isn't about Terminators and that Orwellian apocalypse. It's actually something far worse. The AI revolution is going to be less Terminator and more job eradicator. We got our biggest clue to that last week, direct from the world's second largest employer, planning layoffs as AI takes over more jobs. And 4 in 10 employers are already saying that they're going to downsize due to AI. This all means that your financial future depends on investing in the companies that are going to make that happen. The stock's poised to pop as profits jump on AI advances. This isn't just for investors either. It is a message everyone needs to hear. I'm going to show you the stocks to buy to secure your income. Stick around and I'll also update you on shares of AMD and Circle Internet Group, ticker CRCL. I'm going to show you those stocks to buy next, but first, if you've ever wondered what's in my portfolio or just want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 300,000 investors in the social feed to see what everyone else is talking about. Now, I've shared my portfolio on the app, and it's totally free to download, so look for that special invite link I'll leave in the description below. Back to our main topic, though, and folks, this is a message everyone needs to hear because the AI revolution isn't science fiction anymore. It's not killer robots marching down Main Street. It is your job disappearing behind a line of code and a shiny server rack. The truth is, artificial intelligence isn't coming for you, it's coming instead of you. And we got our most honest preview of that last week when Amazon CEO Andy Jassy admitted that AI will absolutely lead to job cuts, saying, "We will need fewer people doing some of the jobs that are being done today." And this all follows Microsoft's earlier announcement that it would cut over 10,000 jobs, almost 1 in 20 from its workforce this year, as AI just does more of those jobs. Shopify has even gone so far as to institute a rule of no new hires unless AI just cannot do the job, basically transitioning the company to full AI over time. And Nation, this is not just automation or tech changes we've seen in decades past. This is hugely different. Unlike the Industrial Revolution or the rise of the internet, where more new jobs were created as others disappeared, AI and robotics together are specifically designed to replace human jobs, not to assist them, not to support them, but to eliminate them. A recent McKinsey study found that by 2030, more than 1 in 3 jobs will be automated, and 2 in 3, 60% will have been significantly changed by AI. More than 4 out of 10 employers are already saying that they're going to see layoffs as the company integrates AI over the next few years. And this isn't just customer service or data entry jobs, this is every job. An analysis of 19,000 tasks across 900 jobs found some level of AI impact in every industry, with most seeing half or more of the jobs susceptible to AI automation. Look at this chart. More than 2 in 3 jobs could be gone in IT, finance, customer sales, and operations over the next decade. And so here is the important message, the one every single person needs to hear, that the only way to make it through the next decade with your financial future intact is by making sure that if you can't stop the AI revolution, you can at least profit from it. That means owning shares in the companies driving it, getting on the right side of that shift before it's too late. I'm going to reveal those stock picks next, but if you've never invested before, I get it. It can feel overwhelming. I spend hours researching stocks every single week, uncovering every detail in the financial statements, but here's the real deal, folks. Investing can be much, much simpler. In fact, you can secure your financial income as easily as just opening an investing account, starting with as little as $50 a month, and just buying the 3 ETFs I'm going to show you next. Even if you never do anything else, that one decision is going to change your life. Now, I'd love to have you all here in the Let's Talk Money community, but whether you watch a single video or not, you must get started investing. For those of you that have already started investing, share this message with others that need to hear it because companies are building that AI future with or without them, and there are only 2 choices here. Watch it from the sidelines as your job gets phased out, or own the companies doing the phasing and get paid for it. Starting you off, I've got 3 ETFs, exchange-traded funds here, that are going to put you right there in the companies that are going to profit most from this AI revolution. Just these 3 funds are going to give you exposure to 400 stocks, so you could actually put all your money in these and not have to worry about buying individual stocks. With just these 3, you're going to have a complete AI-ready portfolio. And that's starting with my favorite tech stock ETF, the iShares Expanded Tech Sector Fund, the IGM, which holds shares of 283 North American tech companies. This is an all-in-one tech fund with every tech heavyweight on the list, including the Magnificent Seven, Palantir, Salesforce, and ServiceNow. Shares are up 12% in the past year and 130% over 5 years, beating the NASDAQ market index and the QQQ by more than 35% over that period. Now, a more targeted fund and up 18% is the Global X Artificial Intelligence and Tech ETF, ticker AIQ, which is laser focused on those stocks leading in the theme, along with those waiting to benefit on those AI use cases. The fund holds shares of 86 companies and has a global reach with foreign stocks as well. In fact, Chinese internet name Tencent Holdings is the largest stake here. But scrolling down, you're going to find every company in that AI theme, and this is a great way to start your research too if you're looking for individual stocks to buy. One fund you might not think about but should be including, the NASDAQ Cybersecurity ETF, ticker CIBR, up 31% over the last year and holding 32 stocks in my top growth theme for the next decade. Those poised to benefit as those cyber threats increase. The cybersecurity theme is already a $104 billion market and set to increase exponentially with threats from AI, making these stocks must-own for every investor. This fund makes it easy to get all the stocks in one place, but many of these are only loosely related to the theme, like Cisco Systems, Booz Allen, and BlackBerry, so I like to pick and choose from the list for individual investments, including favorites like CrowdStrike Holdings, Palo Alto Networks, and Zscaler. Oh, again, folks, you could get your entire portfolio in just those 3 ETFs, ride them higher with that tech stocks and the AI revolution, never have to worry about individual stocks, but I know all you out there in the nation like to reach for that higher return, so I want to get you started with 3 of my favorites here. Now, all 3 of these are from my recent video on the best deals in AI stocks, where I adjusted valuations by growth and then ranked the 60 AI-related stocks. I'll link to that full video in the description, but it doesn't get much better than Supermicrocomputer, ticker SMCI, with its 47% sales growth expected this year to $22 billion and a rock bottom price of just 1.3 times sales. By far the best deal in AI right now. SMCI is the pure play in AI because it dominates in that space for compute-intense servers, the data center hardware companies need for all those NVIDIA chips they're buying. I'm also buying shares of Symbotic, ticker SYM, up 21% in the last week alone, and with 5,600 shares, I think this one could easily 10 or 20 times your money over the next 10 years. Symbotic is using AI and robotics to transform the $1.2 trillion legacy market for warehouse and logistics, and that market is expandable into the $3.9 trillion global opportunity. It already has its robots in operations at Albertsons, Target, and Walmart, along with recently taking over development for Walmart's warehouse and delivery robotics. In here, you're going to want at least one of the big powerhouse tech names, and none are as well positioned in AI as Amazon, ticker AMZN, developing its own chips and services in Trainium, along with integrating AI throughout its operations. Now, it's only expected to grow sales by 8.9% over the next 2 years, but with a valuation already at 3.4 times revenue, it's the best deal among Magnificent 7 tech names, and that use of AI is going to accelerate profits for the $2 trillion giant. Turning now to the stocks I'm watching this week, solar stocks got crushed last week when Senate Republicans offered their revision to tax credit changes in the budget bill. The Senate plan would see those credits phased out over the next 3 years, which is better than the House plan to eliminate them faster, but still less time than expected. After the House plan was announced, I set up an option spread strategy in shares of Sunrun, ticker RUN, in our May 26th video, buying the $6 and selling the $10 call options for $1.33 per share. With that Senate plan up in the air though, I recommended closing out the position if the stock bounced back to $10 each, which it did on June 13th. I ended up closing out a little earlier than that on my own position, but still made $7,700, or a 58% return in less than 3 weeks. With that Senate proposal now in writing, the solar industry is going to be on life support for a while, and I would only be investing in the very strongest names that can survive. Top within that group would be Enphase Energy, ticker ENPH, which is operating at positive cash flow and has enough cash on hand to cover its debt. The shares are now trading at just 3.5 times sales, deep into value territory, so this could be a good rebound play if you're willing to wait it out. Advanced Micro Devices, ticker AMD, continues to run higher, now 67% higher from the April low, with a runway to my target of at least $150 a share. I've been buying since February, now with $108 per share average cost and up 20%. It's the second largest position in my portfolio at $323,000 on the idea that AI chip boom is big enough for NVIDIA and AMD. More importantly, recent product launches are closing that performance gap with AMD's 350 series showing a 35 times improvement. The company's set to benefit on chip demand as AI transitions into that inference stage. And analysts are falling all over themselves to upgrade their targets, with 16 rating actions just since the 13th, 12 of which are a buy recommendation, though the average target is still just for $130 per share. I continue to argue that on a $32 billion in 2025 forecasted revenue and a very modest 8x price-to-sales ratio, Shares are worth at least $156 each. And this is crazy. Circle Internet Group's ticker CRCL up 670% since its IPO just 3 weeks ago, a record-breaking run. And while I recommended CoreWeave, ticker CRWV, with a similar run up 380% since its March IPO, I think Circle is setting investors up for a big disappointment. I know that's not what you want to hear, folks. The Genius Act making its way through Congress does set up a regulatory framework for stablecoins and a step in the right direction for Circle, but meaningful legislation is still years out, and there's going to be setbacks along the way. Meanwhile, there is almost no analysis or forecast for Circle, which tells me most investors are just salivating over that price chart and jumping in. But if you look at the actual numbers here, folks, you're going to see you're diving into a pool with no water. Looking into the prospectus filed with the SEC, we see Circle posted revenue of $1.6 billion last year, with costs of $1 billion and operating expenses that just under $500 million. That left $167 million in operating income, which is great that it's positive, but that is an operating profitability of just 10%. The operating income divided by that revenue. That profitability is not great, and combine it with revenue growth I'll show you later, and this one gets real scary real fast. On earnings of just 33 cents a share, the stock trades for 727 times on a price to earnings basis and 34 times price to sales. That is nosebleed valuations on a company growing revenue by just 15% last year. Now, of course, some of the premium on that long-term potential to stablecoin growth is warranted, but there are going to be some huge ups and downs in this stock, and I would rather you wait for a better price. Giving you the bigger picture here with the Sector Spiders sector tracker, 5 of the 11 stock sectors managed to close higher last week with relatively strong gains in both energy and financials. Energy stocks are likely to continue to do well over the next few weeks into earnings season starting mid-July as that boom in the price of oil boosts earnings for U.S. companies. Consumer discretionary stocks here are the real wild card, with investors waiting to see how much of those tariffs are going to be eating into profits and how much are going to be passed on to consumers. Stocks in the healthcare sector are now the worst performing group over the last year by a wide margin, down 9.4% against a gain of 9% in the overall index. Losses have been widespread from biotech to larger drug makers and health insurers. Post-pandemic favorite Moderna is now down 80% over the last year, with other biotechs, Regeneron and Biogen, at losses of 40% and more. Even drug heavyweight Merck, ticker MRK, is down 39% over the last year, but now trading at just 3.1 times sales, a steep discount to that 4 or 5x multiple it's traded at in the past. Stocks in the sector are down on the revolving door of the leadership at the Food and Drug Administration, the FDA, and fears of a slowed approval process, but this sector is now in deep value territory and is going to be less volatile if the market dips again. Healthcare stocks are trading for a price of just 16.5 times expected earnings over the next year, almost at the 10-year average valuation, really the only sector besides real estate to be trading at a discount, while most sectors have returned to expensive valuations we saw at the beginning of this year. For example, stocks in the tech sector are now trading at 28 times expected earnings, 29% more expensive than that average 21 times PE ratio over the last decade. And the overall S&P 500 market index is now 17% more expensive than that long-term average. Join me on the Blossom Investing app, free with the special invite link in the description below, and see what over 300,000 investors are talking about. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.